video. How's it going? So today I'm just going to be doing another Reddit D&D read aloud. Just want to get back to something simple. Still not feeling great after the vaccine this weekend, but just kind of low energy and stuff. But so I've done some research. I definitely have some upcoming videos planned. A lot of really cool crypto videos coming up soon, guys. So just keep on the lookout for that. Just a reminder to leave a like, leave a subscribe for me, leave some comments. Those are all free ways you can support the channel. I am doing a small Ethereum giveaway at 50 subscribers and a small Bitcoin giveaway at 100 subscribers. I'm just gonna pick a random person at random at 50 and 100, and if they have a wallet address, I'm gonna send them some money. So yeah, guys, definitely let's get some support on the channel and let's just jump into it here. So this is a fresh, hot off the press DD here from our buddy WardenElite on the Super Stonk Gamestop Reddit thread. So just to preface this for anyone that is out of the loop or doesn't really know what's been going on. So lately, GameStop has pretty much reached an apex point. If we want to pull the chart up here. So yeah, this wedge, we're basically right here, right where the cursor is. We're right there. If we look at this on a smaller time frame, yeah, I mean, the wedge I drew wasn't great, but it pretty much ends like about here on May 7th, either at the end of this week or the beginning of next week. So we're pretty much at an apex point. Looking at the daily chart, today the volume was super low. It's saying 1.77. It was at 2.77, so it could be a glitch. We're not sure. So the liquidity is completely dried up. Today the stock price I think it fell. It opened at 161 and fell to 159, so we're down like $2, 0.78%. But if you look on like the 30-minute chart, the stock has just been trading flat lately. You know what I mean? Not too much action, consolidating a lot. But again, we're at the tip of this apex point. So I personally think there's action imminent for GameStop. Again, I'm not a financial advisor. Take everything I say with a grain of salt. So let's just jump right into the DD. So the title is The Mother of All Wedges, an Endgame DD, Technical and Fundamental Analysis with Warden. Where are we now? Where are we headed? When might the mother of all short squeezes begin? Again, this is by username WardenElite. He is pretty much a big name on here. I'm sure a lot of you guys know him. He just got back from a break. Alright, let's start off here. So, hey everyone, it's Warden. I'm taking a brief moment to write a chart analysis post because I feel that we are nearing a critical junction point. And that part was in bold here. The part, I feel that we are nearing a critical junction point. And I agree with him. The volume today has been extremely low, currently sitting at around 1.7 million. So he wrote this during the day. Again, I'm not going to go into detail, but the volume at the end of the day said 2.7 million and had dropped to 1.7 million like 30 minutes ago. At the time of recording, it's like 5:40 p.m. on the East Coast. So yeah, I'm not sure what happened with that. It could be another glitch, but I don't know. So he said the volume today has been extremely low, currently sitting at around 1.7 million, and I feel that a lot of people are sensing that something big is coming. I've emptied the rest of my bank account into the dip today and to buy more tickets to the moon. There's a lot of questions people are wondering at this point. When do we squeeze? What happens at the apex of a wedge? Are there any important catalysts coming up? These are all the questions that have answers. These are all questions that have answers, excuse me. And I will do my best to address these. My thesis for this post is that as a stock breaks out of the wedge, if it chooses to follow the uptrend, it becomes increasingly expensive and impossible for shorts to bring this down any further. We may possibly climb to a point of no return for the shorts. Let's examine why by starting with understanding what a wedge is. The wedges I will reference in this post are symmetric wedges. Why wedges form and what they mean fundamentally, the long and short thesis. We are indeed nearing the apex of the mother of all wedges. MOAW is what he abbreviates it as. This is the ultimate hedgy wedgie. I want to provide a fundamental explanation for why this wedge has formed and what it means for the stock. Let's examine the simple uptrend. This is when the price forms higher lows and higher highs. So here he made a diagram of basically an uptrend. It's just the diagonals going up, and at the points, at the highs and the lows here, it shows the higher highs and the lower lows on an uptrend. Really simple, basic stuff. And then the next picture is a downtrend. It shows the lower lows, the lower highs on a downtrend scale. And uptrend is called front side, and the downtrend is called the back side. The thesis of people trading the front side is they think it will go up. For short sellers, they trade the back side because they think it will go down. Now, if you get a really volatile stock, you might end up with the combination of the two theses, with two parties doing different strategies. This is why a wedge forms. Both theses are valid, and so both parties continuously trade in this wedge pattern. So there's a picture here of a wedge, which is very similar to the GameStop wedge that's currently happening right now. So it's a right side facing wedge with and in the middle he highlights the lower highs, the higher lows, and they're basically converging into the apex point. So he shows the short side thesis and strategy looks like this, which shows this is a diagram of the same wedge, but it just highlights the shorts moves. So it would be the downtrends within the wedge, and then it's just the opposite for the longs. Again, this is basic stuff. There are some people on the Reddit thread that don't really understand basic TA, so he's breaking it down for them. But I'm just going to assume that you guys would understand basic TA, so I'm not going to go harp on about that too long. So he says, imagine the opposite for longs. They buy at the dips, they sell at the peaks, which is what you're supposed to do, obviously. Thus, combining with these two theses, we can conclude that when the stock moves up, that's buying plus covering, and when the stock moves down, that's selling plus shorting. Simultaneously, longs and shorts are both making money because they have valid thesis. One thinks the price will go up, the other thinks it will go down. Why the short thesis is invalid, understanding the unbalanced volume, or OBV, the spread, and FINRA's own short volume data. However, there is a big problem with the short thesis for GameStop. The short thesis is actually invalid. So he has a picture chart of a chart here, GameStop chart, and on the bottom it shows the OBV. So basically, up until it looks like maybe the middle of March, it looks like the OBV was acting as normal, but then in the middle of March, the OBV, or the unbalanced volume, has just basically traded flat, even though the stock price hasn't been flat. So it is a weird correlation. He says, notice throughout the entire duration of this triangle, OBV is flat, and he has a link for unbalanced volume info. I'm just going to read this quick definition. What is unbalanced volume? Unbalanced volume is a technical trading momentum indicator that uses volume flow to predict changes in stock price. Joseph Granville first developed the OBV metric in the 1963 book, Granville's New Key to Stock Market Profits. Granville believed that volume was the key force behind markets and designed OBV to project when major moves in the markets would occur based on volume changes. In his book, he described the predictions generated by OBV as a spring being wound tightly. He believed that when volume increases sharply without a significant change in the stock's price, the price will eventually jump upward or fall downward. Key takeaways: unbalanced volume, or OBV, is a technical indicator of momentum. That's the key word. If I had to highlight anything out of this, it's momentum. OBV is very momentum based. Using volume changes to make price predictions. OBV shows crowd sentiment that can predict a bullish or bearish outcome. And comparing relative action between price bars and OBV generates more actionable signals than the green or red volume histograms commonly found at the bottom of price charts. So basically that last little section is saying that OBV, which is a line chart, it's a better indicator and more accurate than just traditional volume candles. So take a look at, so we're back to the DD here. Take a look at a normal stock like Palantir. When a short thesis is valid, the price breaks out to the downside after the apex. Palantir in the picture below was a short side success. Notice how OBV falls during a short side success. So it's a chart of the stock Palantir, and it basically shows it a downtrend for the stock, and it shows that OBV is moving with it in tandem. And then another stock chart here, or in Activision's case, OBV goes up when the longs win. So for this chart, it shows an uptrend, an overall uptrend, and the unbalanced volume where OBV goes up. So that's basically just establishing a control, basically. So now I challenge you to find he says, I challenge you to find a stock that doesn't follow these rules on a macro level timeline. So basically he's saying like a broader timeline, like a big scale, the OBV will always follow the stock, and he challenges you to find a stock that it doesn't. OBV increases if there is more volume during uptrends than volume during downtrends. That means there is greater buying interest, vice versa. When there is an imbalance of buyers and sellers at the apex of the triangle, there will be a breakout. This is because at the apex, one of the two trends breaks. Either the upside or the downside trend is violated, forcing one of the parties to flip their thesis. If we go to the upside, the short sellers would flip to long side by buying stock or finally covering their shares. So what about a flat OBV like Gamestop? I believe it means that throughout the duration of the wedge, starting on February 24th, nobody was effing selling. It was almost exclusively short selling, short selling combined by less covering than shorting and retail buying in. In a way, it's actually an illusion that they are tanking the price. In reality, the real price is whatever the uptrend line is. So here, I think the real price is around $155. We've actually been climbing up at the macro level. I think this has to do with the spread. If you look at the level 2 order book, you'll see the highest bid is $160.6 and the lowest ask is $160.74. So there's just a diagram of that. It's just a picture of the order book. The goal of short selling is to tank the price, so you typically sell on the bid. When you want to cover your shares, you want to ideally also buy on the bid because buying on the ask is more expensive. So basically, yeah, buying on the bid is cheaper, simple. However, the issue is that liquidity is so low, so if you have a deadline to cover failure to delivers, you need to buy on the ask a lot. You actually end up losing money, and the amount you lose is roughly equal to the average spread multiplied by how many shares you shorted. The only way to profit from short selling is if people sell more than they buy after you short. Trading is a zero-sum game, so the goal of short attacks is to paper hand people or to get people to sell. The problem is we see consistent higher buy-sell ratio with GameStop, meaning that more people are buying than selling. Thus, you can't make money if you short millions of shares because eventually when you cover, A, you will lose money from the spread, B, the price is already increasing from an excess of buyers. There is no C, I'm sorry. I said it like there was a C. Furthermore, what's even worse is that the daily short volume is greater than 50% on average. Username Dinghino crunched FINRA's own short volume numbers and concluded that the majority of daily volume was short selling. Here's his tool, So there's just a chart that shows that the majority of the daily volume for GameStop is short selling, and that apes like myself are diamond handing and we're not selling our shares back into the market. So hedge funds can cover. We're holding our shares. Keep in mind, FINRA both underreports short volume and total volume, so the data we have is limited in reliability. There is a probability that short volume might be under 50%. Or it might be over 50%, I'm sorry. I have not been able to find either data sources, Okay, so first we realized that they cannot really profit from shorting on a downtrend, and second, despite this fact, they are shorting more than half the daily volume. Ouch. Now let's tie in the last two pieces of the puzzle. So how can there be a flat OBV if there is an excess of buyers? I believe it's because the bid has been hit so much more than the ask from the short sellers that it has caused the price to be artificially lower than normal. Thus, there is an increased number of days that the stock ends in the red, decreasing OBV. I believe that the OBV is actually trending upwards. It's an illusion that it's flat. The bid has been hit from selling more than buying has hit the ask. Therefore, the net direction is down. The excess of retail buyers balances this out and causes the OBV to end up flat. We are not losing this fight. We are in fact holding strong and buying. Furthermore, from the updated institutional data for quarter one presents so far in Bloomberg, we see a couple of institutions de-risking and others actually buying more shares. Some institutions appear to be out, but a lot more actually in. Institutions are holding so far and perhaps actually buying in. Keep in mind that this is a tiny subset of all the quarter 1 13F. So there's a picture above of institutional ownership, and he's saying that this is only a tiny subset of all quarter 1 13F updates. And the new updates will be listed on May 17th. So we'll be able to see more up-to-date FINRA data and Bloomberg data. I believe 5/17 will be a very important deadline for us to find the new data. So great, everyone is holding thus far. Shorts keep shorting, and the spread and buyers are killing them. LOL. After the apex, shorts will drown. After the apex, the downtrend breaks. Shorts will be forced to create a new downtrend. If they haven't given up, they'll likely react with a large short attack in an attempt to establish a downtrend. However, given that GME is hard to borrow, they can only short a limited amount of shares. And because people won't sell, the shorts will be stuck trying to short into an uptrend due to an excess of buyers. This is a short staircase, the establishment of a new uptrend slightly below the apex that will slowly choke the shorts to death. Every time they try to bring us back down, they have to eventually cover on the ask. Couple that with buying pressure, their short attacks get weaker and weaker each time as this uptrend slaughters their profit and loss. Take Tesla as a historical example. A short staircase choked the short. They were like, "Oh, I'm screwed. Better cover." So there's just a chart, a Tesla chart, a long-term Tesla chart that shows the short staircase where the shorts got screwed and there was a big spike in the price of Tesla. Seriously, I see no effing way out for the shorts. To create a downtrend, you need a continuous supply of shorts, or you need people to sell. Both options are out of the question. The catalyst might actually be the chart itself. Not so much a fundamental change in the company, but a fundamental change like a new CEO can certainly light the fuse. Summary TLDR. Wedges form because longs and shorts both see a profitable strategy. Shorts are not able to profit because of the spread and the excess of buyers. OBV is flat because everyone is buying and holding. The price might drop after the apex, but an uptrend will form that will smother the shorts. Eventually, they will panic cover. Bloomberg shows recent institutions are buying and holding on average. After the apex, the short thesis of being profitable from shorting becomes invalid, if not already. May 17th is an important date. It reveals the poker hand of the longs as 13F quarter 1 filings are due by then. If they are still holding, then shorts are doomed. The price isn't actually decreasing from these short attacks, it's actually steadily increasing. The drops are an illusion. Thanks for reading, and I'm bullish as ever on this stock. Warden. Whew. Alright guys, so that was a little bit of a long one, but I just had to get this information out to you guys. This is what I believe to be, like this week, next week. The time we're in now, in regards to GameStop, I believe is what you would want to call crunch time. Again, I'm not a financial advisor. Take everything I say with a grain of salt, but I believe that we are approaching liftoff. If you want to call it that, I believe we're approaching the apex point. And if we pull back up this chart on WEBULL, if we look at the 1 day, we are approaching. Let me just zoom in a little bit. We are approaching the apex of this wedge, like he had basically Warden drilled in our heads through that DD. And, we're going to see some kind of a breakout here, whether it's to the downside, to the upside. But, a downside breakout would basically kill the shorts, you know what I mean? They're still going to have to cover. And that was kind of the whole point of Warden's DD is basically that, we're almost in a position that's unwinnable for the shorts, you know what I mean? So, yeah, guys, I just wanted to get this information out to you guys. This is an audio version of a DD, so to speak. So, leave your thoughts on this information in the comments. Leave a like on the video, please, to support the channel. Subscribe to the channel to see future content. I am going to be finishing my setup in here. I'm going to have more videos coming out more frequently and sooner. So, yeah, guys. I'll catch you in the next one. Thanks again. Enjoy the rest of your day.